Hi everybody, this is Sean Overton with OneStepRemove.com, and in this video I have Michael Halsmore. Michael's the owner of quantstart.com, a blog about algorithmic trading. Mike, thanks for joining me.
Thanks, Sean.
So Mike, you have one of the more interesting stories about how you got involved in finance. You want to tell us a little bit about it?
Yeah, I mean, I came out of postgraduate school, and essentially one of my friends actually, after going through a startup, he actually said, would you like to be involved in an investment of his, which was essentially a quant fund, a prop fund. Right?
It's a nice guy to know.
It's a nice guy to know, exactly. And so I became essentially their kind of systems developer, or quant developer, I guess you could say.
Okay.
And then with that, we essentially traded for about 2 years, and we really started from scratch.
And everybody has this impression of what a quant is. Like, you hear quant developer, quant trader. What is that?
So, I mean, the quant word I think is overused quite a lot.
Okay.
And what people really mean by it is something that involves generally maths or statistics in finance in a kind of quite heavy fashion. So it can mean anything from the guy programming the trading infrastructure right the way through to the guy doing the sort of hardcore sort of trading research, and strategic backtesting in a kind of very computational and statistical manner.
Right. Yeah, it's very nerdy. Yeah, you got the propeller heads. They're in the back room.
Exactly. Yeah.
So when you're developing a strategy, how important is the actual rule for buying and selling?
Not as important probably as other aspects. I mean, you could think of it as one big whole system, right? So you've got pricing to deal with, data cleansing. You've got what they call the alpha signal generator, right? The bit you mentioned, and then you have the whole execution and exchange modeling and an execution process. And each of those areas has its own unique challenges essentially, but I see the sort of signal generators kind of one bit of a very much larger system, which is not as so the importance is on all of these systems working absolutely well rather than one in particular.
I get used to signals, so not to highlight any system, but say you have a moving average cross, something everybody knows, and you just look at the signal and you think, oh, if I woulda, coulda, should have done this, then I would have made loads of money. But that's not what quants or funds do at all.
No, depending on the frequency of what they're trading, right, which is a very important factor that probably differs quite a lot from retail. Retail is very much at the lower end of the frequency. I mean, there's still money to be made, of course, right? But quant funds tend to be generally more of the higher frequency, and so a lot of what they will be studying is optimizing of technology and strategies that are really involve the kind of market microstructure, as they might say, of the particular assets they're trading. And so that is quite a different approach generally to I've seen that I could have bought there, might have sold there. It's very different sort of approach. Signals will be generated in quite a different way, I think.
Okay. What is the typical time frame? What's the difference between a retail trader, a guy that just has a trade robot that he bought off the internet, and a guy that's developed it and he has a statistics background and he's a true quant?
Right. Well, I mean, depending on what you're trading, I mean, it could be anywhere from the guy who's bought the robot. You want to really, for that sort of guy, I think he'd want to be sort of checking it himself and making sure it's not doing anything stupid.
Right.
And so you wouldn't really want to be doing more than a few trades every minute, probably. I mean,
that's the absolute cap.
Well, it's whatever you can cognitively handle, right? But in the true quant sense, the ultra high frequency stuff will be kind of microsecond and even nanosecond kind of scale, and that obviously is not how it takes 300 milliseconds to blink, so you can imagine the kind of sort of latency that you have to deal with in that space. So it's very different kind of mentality. It's all done by the computer. So
when you're competing against quants that are trading in microseconds, and your technology is streaming from the US to your broker server in the UK or whatever, how do you compete?
Well, you essentially don't, right? You're playing on a different playing field. I mean, they're dealing with differences on these incredibly tiny time scales, and they have their own little games going on down at that level. And as a kind of longer term, so lower frequency trader, you're not really hugely sensitive to latency. If you're trading for once every week, latency is not going to be your biggest problem generally. So
having been on the inside and worked in funds, where do you think the retail trader has the biggest opportunity?
So there's you know, as a retailer, you could go for more of a higher frequency style strategy, and there are plenty of spaces out there where bigger funds, because they've got quite a lot to invest, aren't able to compete at the lower scale of money. And as a retail trader, you can go there and you can make money even with relatively sophisticated strategies, but you do need to be quite computationally aware. You know, you need to be good at programming and probably have a bit of a background in maths and stats, I'd say, for that, to compete at that end.
So when we talk about quants, for whatever reason, that is almost always associated with high frequency trading or even ultra high frequency trading. In my mind, anyway. Is that?
I'd say. I mean, there are plenty of quant funds who tackle lower frequency stuff. I mean, there's quantitative and there's automated in some sense. You can have a very low frequency automated strategy. It's just that quant funds, by virtue of generally who they hire, almost they'll be working at the higher end of the spectrum, because that's generally where they have the skills to compete, right?
So why is that? Why do all the funds focus on these short-term, get the money right now, real quick?
I think it's because they take quite a scientific approach to how they trade, so they'll be actually trying to exploit kind of physical inefficiency of the system some of the time. So it'll be quite different from, say, coming up with as you sort of like a technical signal and just going for it. They'll be saying, right, well, hang on, the exchange works like this, they use this infrastructure, can we exploit that somehow? This, you know.
So it's just pure arbitrage. Something very close to it.
Yeah, I mean, there's lots of different strategies. One of them being, you know, obviously arbitrage, but there's lots of you know, we know the infrastructure better than the other guy. So as you say, it is, you know, it is done that way. But you can see how it comes from very much a sort of hypothesis first, trade signal second mentality, rather than let's see what indicator gives me a buy and sell strategy. It's done in a very different way.
So what is your opinion? Do you think you need the science background first and then you try to figure out trading, or is it better to have the trading background and then you try to develop a strategy?
I think you need a mix of both, to be honest. I mean,
so you can't just be a nerd and have a PhD and you're
I mean, you can come up with the best forecasting system in the world, and if you can't, if you don't understand risk management and you don't understand position sizing and you don't understand these very core sort of bread and butter ideas in trading, you're going to lose money, right? Because you won't understand that you won't have done any statistical analysis on your drawdown characteristics or your loss,
or even know what drawdown is.
Or even know what drawdown is, right? So you cannot. I think, as you said, you need to have a mix. I believe you need to have a mix of both, frankly, to do well.
And before we actually started recording, we talked a lot about risk management. What is that in your mind, and how do you best go about coming up with a risk-averse strategy that makes money?
So I think retail and funds have a very different approach to how they deal with risk. Right? I think in retail, from my experience, it's seen as kind of secondary consideration to the signal generator.
In a bad way or a good way?
In a bad way. I think it's seen as the more boring, dull area of trading, and you know, you can see why that is. You know, because
like you're telling me I can't make as much money as I possibly can. I got to dial it back.
Exactly. But I mean, this really comes down to the differences in how retailers and funds operate. Funds have institutional mandates. They have.
So what is that?
So that is they have to generally present monthly performance for what they're doing. Some investors will actually ask for daily performance or real-time performance, and so you're really under the magnifying glass a lot of the time. So for that reason, your primary concern is not losing money rather than gung-ho.
And this is for the institutions?
Yeah, this is for the institutions. So especially if you're larger institutions like pension funds, who the people are putting in, they will...
Well, it's people's pensions.
It's people's pensions, right? So they're not going to just throw 100 million at you and say, go for it. You know, they will do an extensive amount of due diligence on you. I mean, years of due diligence in some cases, and so they will want to see very sophisticated risk systems in that regard. So I guess a few examples would be let's have a think. So they would want to see exactly how you go about leveraging up and down, and what your actual mentality is for leveraging up and down. You know, it's not just picking it out of the air. It would be
a protocol, and
very much a protocol. And they'd want to see what your kind of downside insurance policy would be in that regard. So the classic kind of put option, to make sure your portfolio, these sort of things.
So they're stress testing you.
Yeah, I mean, you'll also be stress testing yourself, right, all the time.
Of course.
I think, there's the industry standard like VAR, which is the classic classic stress testing thing. But it's more of a culture difference, I think. It's a risk first mentality, right? You're always thinking, how much of this is going to affect my portfolio swing? How much is going to, how much of is going to be the average volume that I'm trading, and that sort of thing. So it's just constantly assessing risk. Whereas in retail, I think it's mostly, what's the signal going to be?
Exactly. So if you are retail, and we obviously retail traders are primarily profit driven, how does that change your approach? So if you were in an institutional environment, you're risk management focused in terms of you want to make money every day, even if it's a fraction of the potential money. But if you're trading your own money, within certain restrictions, and you can only tolerate so much drawdown, within that drawdown, you want to make as much money as possible. How do you go about doing it?
So there's a couple of actual specific ways. I mean, the classic is the Kelly criterion, which is a means of adjusting your leverage based on the amount of account equity you have. So it can get a bit mathematical, so I won't delve too deeply into that.
Sure, you can Google it.
But it's that's, and then the more conservative uses of leverage and cutting back on leverage. So that would be very much controlling your drawdown and your growth rate as a sort of slider almost. You say, right, well, I'm happy to reduce my drawdown, but at the expense of not gaining as much growth. That is fundamentally, and obviously any trader doesn't want to lose their entire equity. So
that's called gambling.
Yeah, exactly. So they'll fundamentally be using some principle like Kelly is quite a common one, and you can go anywhere right up to as I said, the put option mentality. You could basically only trade half your account, and literally put 50% of your account aside, and then just if you lose your entire amount, you've only lost 50%. I mean, that in itself is actually quite a good mentality to have in some regards.
So if you, I've used Kelly before, and sometimes you have systems that have done way too well in the past, and you plug in the numbers, and the optimal Kelly is something like risk 30% of your account on some average. But I know from experience that's dumb. So what do you do? How do you handle that?
Well, I mean, you tend to have overlays on top of that, right? I mean, so you could. I mean, another actual mechanism that is used a lot in quant funds is what's called leading risk indicators. So you'd have things, especially in equities, where you've got all these new shiny exchange-traded funds popping up all over the place. Some of them will be measuring very interesting things like the VIX, which you probably heard of. This is the implied volatility index of the options on the S&P 500, right? And some people use that as a mechanism for essentially saying, what is the future volatility going to be looking like? And so you would incorporate a lot of these, and if you can imagine putting all these different factors into a pot and essentially saying, well, okay, my overall leverage is going to be this. It's not just dominated by Kelly, it's not just dominated by the VIX, but mixing them all together and getting a kind of holistic view.
And so you're mixing and you're not just saying, here's my entry signal, you're saying, here's my entry signal, here's my system that goes within the entry system to come up with the best trading size.
Yeah, I mean, in some sense, the signal generator is piping information to a sort of more important risk management system that says, okay, yes, okay, no, or downscale that by this much. So the signal generator is kind of convincing the risk manager whether or not to do the trade, rather than the signal generator being the be-all and end-all decision maker, right? So the risk management layer is generally much more important and much heavier at doing if that makes sense. They're the ones.
It does. Do you think you could make money if you say that you're trading Forex or equities or whatever, and you're pushing through 100 shares every trade, and you have a stop loss of 50 cents every time? Do you think you could make money doing that?
I mean, it's interesting because stop losses, they're quite a controversial thing to do in trading, right? I mean, so
are they? Because retail traders,
well, in trend following, definitely they are a fundamental part of the strategy. Generally, you have lots of little mini losses, and then all of a sudden the big whacking great mega win. So, and you obviously, if that reverses, you don't want to lose it. That's the whole point of a stop loss. But in mean reversion, I think they're a bit more difficult to utilise, and given that a lot of quant funds specialise in mean reversion, they may or may not be using stop.
Really? So you have these huge institutions that are really prestigious, and they're not trading with stop losses?
Well, I think you'd assess it in a different way. I mean, you would say to yourself, right, what is the kind of historical distribution of returns we've seen in our backtest under this, and then you'd say, well, I've seen a 50% drawdown in the backtest. Either you might say, right, let's just get rid of the backtest and start again, but you'll see some drawdown in the back test and you say, okay, well, in the future I'm likely to see that drawdown, and if not much worse. So you would essentially cap it in that regard.
And that brings up a good point, because a signal works and you back test it, you feel good, and unless you get really unlucky, it should work up to some point in the future, and then it stops.
Yep.
So that begs the question, how do you know when an algorithm is in a drawdown and when you need to turn it off?
Okay, so I think before you even begin trading it, as in you carried out the backtest phase, you would then say, right, I've seen a 25% drawdown in my backtest, right? Which to me would be pretty high, right?
That's hard to ride through.
We'll just pick a figure, 25%. If I got anywhere near 25% in my walk forwards, in my actual out of sample test, I'd just turn it off. I think, or
just time to do something different.
Well, the reason I would turn it off is not because I'm expecting 25% in the future. It's because I'm aware that I do not know. There's unknown unknowns that could creep in, and it may even get much worse than that. So, your backtest is only as good as the data you put in.
Yes.
So you should be expecting worse drawdowns generally in the walk forward.
So that raises a good philosophical point, right? You can't know that your strategy is going to make money in the future. How important do you think it is to try to disprove the strategy? Like, what's the value in that?
So I would actually come at it from the point of disproving it. I would use the backtest not as a means of putting something into production. I would use backtest as a means to filter stuff. Imagine starting with like 100 strategies, right? You can then use a computer to backtest the lot. You would filter 95% of them out immediately, and then
just because of drawdowns.
Drawdowns. You're not happy with the statistical properties of the. So, for instance, you might not like the fat tails, as they would call them. It might be too much for you. So you're always looking at a kind of filtration mechanism. You want to find a reason to get rid of it always. And if you're happy that you've not found any reason to get rid of it, then you'd put it in, as opposed to, I've started with this, let's try and find every reason I can to keep it in. So very different mentality in that regard, I guess.
And you mentioned fat tails, and we've talked about trends, and we talked about range trading. What's the relationship between those trading styles and the fat tails, and what are fat tails for people that don't know?
Okay, so a fat tail would mean, so a lot of finance is based on the assumption that returns are normally distributed, meaning they have relatively thin tails, that there's less extremes occurring than probably do in real life, right? So you would say they'd have fat tails. This is the kind of Taleb approach. He says that
the black swan guy,
the black swan, right? There's more extreme events than would occur than you would assume under a normal distribution, they would say. So you'd be using a distribution that has much more extreme events more commonly.
Okay, in the quant world, because Taleb writes scientific papers and he writes black swan and pop literature type stuff, how popular is he?
He's a character, certainly. He has very interesting strategies that sort of exploit his belief that these fat tails occur more often than not. They're difficult strategies to carry out.
How are they difficult?
Well, they're the opposite of what I would call the pennies under a steamroller approach. Right? So you're taking, it's very similar to a kind of momentum trending strategy where you take lots of mini losses on selling these options, these out of the money options, and then every now and then an extreme event will occur and these options will come into the money. And he believes that these options are obviously mispriced, such that he can make more money by.
Do you ever know when you're due for a winner?
No, basically. It's you can only ever say, historically over this time period I've seen this amount, and you can never be certain, right? You're trying always to fit essentially a statistical distribution. You don't know what that distribution is in real life, and so you can only sort of estimate as best you can that distribution, and then hope for the best, right? In his case, but in my opinion, it's quite a tricky strategy. Yeah.
So let's say that you have a suite of range trading strategies and you have a suite of trend trading strategies. What do you feel more comfortable with in the future?
This is an sort of discussion that very much goes back and forth depending on which year we're in, right?
Right. Where am I making money?
Exactly. So it's I would say quants tend to be certain quants are ambivalent to either. They will basically try and assess what type of market regime they're in, and they will then apply
Do they do that quantitatively, or do they just...
They do, yeah. So this is quite a sophisticated area, actually, and it's a very tricky one to get right. So there's a lot of filtering mechanisms, there's kind of machine learning technology that would be used to essentially try and ascertain whether you're in a kind of, what you call a range-bound approach, or a mean reverting scenario, or a kind of trending market. And there are lots of ways of doing that, but you've got to say to yourself, well, what timescale am I talking about? Am I talking about years? Am I talking about days? And it's when you have a market regime shift. I mean, it's an unknown in some sense. I mean, you can have a kind of view on interest rates, right?
Right.
And you can model interest rates but that is just kind of a purely random event in some sense. So it's very difficult to keep it in mind. You'd have to sort of look over historically what the ECB have done and say, well, how likely are they to drop rates? And some, the more sophisticated firms will obviously be tracking all this fundamental data, and they'll be putting it in as part of their models. So in some sense, they would have probably more of an edge in that regard to to be able to detect these things. But it's tricky. Market regime detection is one of the hardest problems to solve in quant finance, I'd say. And for that reason, it's to actually be able to answer whether a mean reverting or a trending strategy is better at any time. I think it's very asset dependent and very dependent on which year you're in. And, so a tricky one.
And with trading, it depends on what you're trading. If you're trading Forex, there's like 20 to choose from.
Yep.
But if you're trading equities, you have the opposite problem. There's 5,000 to choose from.
Yeah.
So how do you pick one?
Well, I wouldn't be going and picking stocks in that sense, in the traditional sense. I would try and find some kind of economic relationship between a pair of stocks or a triplet of stocks, or ETFs generally, because you can take a more...
Yeah, why are ETFs so popular?
So they're really quite interesting, because what they allow you to do is a company, the fund that sets them up can basically say, right, we're doing this specific thing, and we will then give you an exchange-traded instrument that does this. So you might have a basket of gold stocks, right, and then an ETF for that, or you might have an ETF that triple levers up the NASDAQ, or minus triple levers the NASDAQ, or something like that. And so you've got a lot of sophistication to buy and sell these instruments without having to, because they're all exchange traded, they're basically stocks, right? That's how they act. And so they're also generally very, very liquid on certain things. So
the biggest example I can think of with an ETF and tracking error is USO. Yeah. That's the oil ETF in the US market. And I don't know what it is now, but years ago it was 10% a year. It's enormous. Are ETFs the dumb money, where you know that they're going to do something and you exploit it?
When they first came out, there was a hell of a lot of index arbitrage that tried to, especially on the classic, the S&P 500 and the SPY and whatnot, and people trying to exploit the differences in that. And that can still be done, but you're investing a significant amount in your technology to do that.
So what is the advantage in the current market with ETFs?
So I would say it's not so much any kind of arbitrage on that, so much for the retailer, at least, if we're talking in that regard. It's the ability to say, well, okay, this ETF has something to do with mining, this has something to do with oil, and there's fundamental underlying relationships between those two commodities. Okay. And you could come up with a kind of scientific hypothesis for why, say, a company that has a basket of gold stocks plus another ETF that measures the spot price of gold or tracks the spot price of gold would in some sense be correlated, or and you can exploit that correlation and trade off it, basically. It's a much more scientific approach to you're not basically taking a punt on any firm. You're basically trying to exploit some kind of economic relationship that should, by virtue of the definition of the ETF, stay there. Okay, so you aren't just running math models. You do have to know what the market is. And definitely. I mean, you're always coming up with kind of these fundamental ideas. There are obviously quant funds that are purely price-driven, and they just literally are trying to forecast prices from prior prices without any concern about fundamentals. I mean, my personal view is that you need to mix the two, because of these black swan events, right? I mean, if there's no prior horrific volatility in the price series and you base a model on that, then if you see you're not going to expect a big downward volatility, even though one may have just happened prior to your look-back period. So it's I think going solely on price is a tricky one, because it will probably hurt you in the future.
Okay. So when we talk about performance, a lot of people have, again, quant, very high level. It's a sexy term in finance. What's the highest performing return that you've ever seen in institutional finance?
The highest public one that I've ever heard of is, well, the really famous one is Renaissance Technology. They're the big fund in the US, ultra secretive, hires the best mathematicians, statisticians, and I can't quite, I think they're Connecticut, but don't quote me on that. I think that's where they're based, right? Yeah. They have a huge, they're 35% return every year after fees on average, I think.
Okay, so that's the absolute best of the best with math PhDs.
Well, bear in mind they've got a lot under management, right? Okay. So for them to get that return with that amount of money is incredibly impressive, because it's quite easy to get a much higher return if you've only got a small amount to invest, if you're doing something in the kind of high frequency space.
We talked a lot about quants that leave and they go manage their own money, and they're trading six-figure account balances, which is a lot of money in real life, but in finance it's not a lot of money. So what kind of returns, if they're really good, are possible on those kind of balances? You hear through the grapevine, people doing 20 to 25%, I guess, and probably per year.
Yeah, per year. So, but you really want to be looking at their risk characteristics as well with that, because that figure cannot be quoted in isolation.
No, of course not. But everybody, you see.
You like to hear it.
Yeah, you just want to. How much money did I make?
Yeah, exactly. I would obviously want to look at volatility characteristic as the main one. Then you obviously have the Sharpe ratio and whatnot. But I think you could make quite a lot of money, but then next year you may blow up because you've over-levered. So I think the question really becomes, what's the kind of good return on a sensible leverage that is likely to last long term? And I think you can generally do 15 to 20 if you're really good and you're exploiting something that is an actual exploitation of a process rather than sort of a punt.
Right. So with quants, one thing that caught my attention is you don't have a magic algorithm, like one algorithm that does everything for you.
Yeah, I would say it's the exact opposite of that. You have loads and loads of algorithms. You've got plenty of ideas coming out of the academic woodwork. There's tons of stuff that you can trade and you can replicate. You tend to have strategy lifetimes where this thing will last for 6 months or a year. Then you'll know that, and you'll be prepared for it to die off. And you have to sort of.
Would you even consider a time cutoff for a trading strategy?
No, I think you would generally keep it going until it's not performing at the sort of level you expect in your whatever mandate you have.
So you're basically hoping it doesn't fall off a cliff, that it just decays.
Yeah, generally they do. The sort of slightly lower ones do tend to just decay like that.
Okay.
But the higher frequency ones can have a bit of a cliff fall off, and you can see why, because they're exploiting things like underlying hardware in the net. And if the exchange decides to upgrade its hardware, or some other algorithm comes in and fronts you, that just immediately destroys your alpha, right?
That's a tough way to walk into the office and you're like, oh, our strategy doesn't work today.
I think that's why these high frequency guys get paid quite a lot of money to suffer through the pain that is these sort of 6 months research periods where it just the rug can be pulled out from under you in like a day, right?
Do these guys have high stress jobs?
I wouldn't, from what I know in the high frequency space, I'd say it's not much more high stress than any other job in finance. The hours aren't going to be crazy because they need people to be able to think, right? And there's all the studies that say that anything beyond a 40-hour work week, your cognitive ability diminishes pretty rapidly. They know that. They're generally data-driven people, so they're not going to make you work 80, 90-hour weeks. It's pointless. It's not productive, right?
Okay. Well, not all of investment knows that. So
yeah. There'll generally be more hours than average, certainly, and there'll be deadlines, clearly. But it's much more of a performance-driven kind of environment where, as long as you're getting things done and you're making money, we're not going to make you stay 80 hours a week. It's not like M&A, right?
I think about iBankers and they just, they work 90 hours a week and they fly around the world, and it's just, it sounds cool, but it's not.
Yeah, a tough game. I think, in that.
So, would a quantitative trader be up at night thinking about, oh God, I've only made 1.5% this month and my boss is expecting 2%?
If they're a sort of smart fund, you're going to have monthly losses, right? Sometimes it's just the way it is. At least at the lower frequency, that's part of the game. And it's difficult because you'll know in your backtest that you're going to be expecting these periods. But as you said, you'll see a nice upward equity curve with looks great. in history, but when you actually go through that process, if you were to follow that equity curve yourself, there are periods in it where it's dropping a lot, and so while you're expecting those drops, it's still painful at the time. It's what's going wrong, what's happening. Nothing may be happening because the statistical properties are identical generally to what you've seen in the backtest. It's just that you're going through the particular period where there's drawdowns.
You look at these tests, you get really involved in it, and it's all scientific, and it has a very mathematical approach. Do quants ever panic?
Oh yeah, definitely. I mean, it's because you're always worried about what you don't know you haven't included in your model, essentially.
Okay. So you're aware that you have not created the perfect model.
I think anyone who trusts their model implicitly is probably not really thinking from a fully quantitative mindset in that regard, because by definition we've called it a model, it's not reality, so there's going to be things it's missed, obviously, and it's only a proxy, so there's always things you don't know. I mean, if this is the whole ethos behind the Wall Street crash, 2008, so had the models had everything in there, this probably wouldn't have been an issue. But but they didn't. And I mean, there's really famous examples like long-term capital management, which is one of the classics. They had almost a black swan event with Russian bonds, Russia defaulting, right, and that essentially blew them up. So,
oops.
Yeah, oops, exactly. But would that have been in their model? Would they have expected Russia to default? It's quite a black swan style event. But you probably wouldn't have put it in the backtest.
So does a quant ever get jumpy?
It depends what you do. You're constantly researching new models, and you're very aware of their performance all the time, continually measuring their performance. But you understand that there are drawdown periods. You live through them. As long as you've got savvy investors, sometimes you do, sometimes you don't. They will understand that you're going to go through periods of drawdown. But it's never fun. I think it's it's
always like, I lost money.
Exactly. It's what you really want to be saying to yourself is the model doing something that I'm not aware of? Is whatever's happening something to do with an unknown?
Right.
Or is it something that I'm just seeing a bad period, and that's the way it is?
Mike, I think what you're telling me is I can't just come up with an algorithm and then move to the beach and forget about it.
Yeah, there's no sipping martinis, really. I mean, there's this really funny anecdote, that a quant fund only needs two entities to function, right? The man and the dog. And, the man is there to feed the dog, and the dog is there to make sure the man doesn't touch the computer and let the strategy run.
Does it? Okay, that's what that's really what I'm asking. Is I have this big red button theory where, especially traders that buy these robots, that they just hit the eject button the moment something doesn't go right. Yeah. Do quants do the same thing?
There's a very natural tendency to want to interfere.
Okay.
And it's often the case that interfering will generally have an adverse effect. The classic situation would be, you think your model's not fully dealing with the antics of a market open correctly.
Okay.
And so you feel that if you wait, say 10 minutes, you might get better execution. That's a discretionary, as far as I'm concerned, that's a discretionary overlay, and it's not adhering to the model. I mean, you'd have to say to yourself, well, hang on a minute, is my model then accounting for these, the dynamics of the market open, and,
sure.
and should I now be putting these into my model going forward? If you're doing that kind of micromanagement, I think it becomes dubious at best as to whether you're actually running a quant strategy or not.
Excellent. All right, well, Mike, I think we're out of time.
Yeah,
but I want to thank you for joining me.
Yeah, thanks.
And everybody, thanks for joining us. And I'm going to cut it there.
Yeah.